Um, this is just 8 pages long and there are no schedules. And this is a form I'll be going through in this talk. There is an explanatory booklet which I will refer to, IHD 206, but even this document comes to 30 pages. So although the IHD 205 is much more straightforward than the IHD 400, you still need to be careful. Before I go on to the actual form, just a point about the calculation of inheritance tax. This is not a lecture on tax. This part of the webinar is just to explain very basically how you calculate whether the estate is liable. If it is, you will need to do further research on how to calculate exactly how much you must pay. The tax-free band, nominally called the nil rate band, or NRB, is £325,000 per individual. This means that if the deceased estate is less than this figure, £325,000, there's no tax to pay. Once the estate comes to over this figure, then tax is charged at 40% on the amount over the £325,000. That's straightforward enough. If the deceased estate clearly comes within that figure, then you should be okay with going ahead with the IHD 205. For example, in my part of the world, the average cost of property is £150,000. If it is owned in joint names, then each co-owner's share is £75,000. Even with all their savings, most people fall well within the nil rate band limit and there is no inheritance tax to pay. There are also reliefs and exemptions which I can't go through in this webinar. It isn't intended for that purpose. But there are 2 reliefs I would like to mention, albeit briefly. Firstly, the transferable nil rate band, or TNRB. This applies to married couples and civil partners only, not to married couples, unmarried couples, no matter how long they've been together. So how does it work? Well, as mentioned, each individual has a nil rate band of £325,000. If a spouse dies having not used his nil rate band, then the estate of the second spouse to die can add that to her own NRB, nil rate band, making a total of £650,000. This figure can be eaten into if this first spouse has made lifetime gifts during the 7 years immediately before he died. If this is likely, then you must check his records, as this can materially affect whether tax is payable or not. The other important point is that even if you're entitled to claim transferable nil rate band, it doesn't happen automatically. You've got to claim it using the form IHD 217, which I'll come to later in this webinar. The other relief I've got to mention is the residence nil rate band of RNRB. This again is very complicated, and if your estate comes within the £325,000 mark, as mentioned above, then you may not need to worry about it, but you should have some idea about it. The basic elements are that it again only applies to married couples or civil partners. It can only benefit people who are closely related to the deceased, and it only applies to a residence, although there is a wide definition of what that means. The level of RNRB, residence nil rate band, is going up by stages. It started off as £100,000 per person, but is increasing by £25,000 amounts. So currently it is £125,000, and in 2020 it will reach a final figure of £175,000. So in 2020 you'll have the normal nil rate band of £325,000 and the residence nil rate band of £175,000, which means that for an individual, the tax-free band will be a potential £500,000, and for a married couple or civil partnership, it will be £1 million. So now we'll get on to the meat and potatoes, and that's the form 205. Right, so as you'll see, it's in 5 sections. I'll go through them in detail in a minute. Questions 1.1 to 1.7 is about the person who's died. Questions 2 to 8 is about the estate. Questions 9.1 to question 13 is about the assets. It goes into detail as to amounts here. Or rather, box 14 deals with exemptions, and finally we get to the declaration at the end. So I'll start off by saying, please read the paragraph at the top left of the form, headed when to use this form. You'll note reference on the top right as well to the guidance notes in IHT 206, which I would recommend you using. Now, as to the actual questions, page 1, question 1. This is obviously about the person who's died, and this is pretty straightforward stuff, and I don't think it needs any particular guidance. Question 2, about the estate. This does need a bit more care. You will recall that I mentioned before about the nil rate band of £325,000, and that if the deceased made lifetime gifts, then that can eat into that tax-free band. This question makes it clear that you can ignore the first £3,000 and any birthday or marriage gifts. You just have to say yes or no at this stage. The form asks for amounts later on in question 9.1. The question also asks whether the deceased made any lifetime gifts. If the deceased made such gifts worth more than £150,000, then you have to stop this form and complete the IHT 400. So now page 2, questions 3 to 8. These are a series of questions designed to see if you should be using the IHT 400. So question 3. Obviously, you need to read the question, but essentially, this is about a situation where the deceased has disposed of property but continues to derive benefit from it. For example, he was living there, or he derived some income from it, or he made some contribution to the purchase price. If you say yes, then stop filling out this form and start on the IHT 400. Question 4. Did the deceased get benefit from an asset which was held in trust? As I've said before, if the deceased had an interest in a trust, which was part of his estate for IHT purposes, inheritance tax purposes, then that is not within my definition of a straightforward estate, and you will need professional advice. If you say yes to this question, that the deceased did have such an interest in such an asset, then you will need to complete IHT 400. Question 5. Did the deceased own property outside the United Kingdom? If yes, then again you must complete IHT 400. You'll be beginning to see a pattern here. Question 6. Did the deceased pay premiums on a life policy that is not for his benefit? Again, if yes, IHT 400. Questions 7 and 8. These questions really need to be read together and need care. Question 7 says, did the deceased have any kind of pension arrangement other than the state pension? Now, the answer for many people these days has to be yes. If you say yes to this question, then you have to address question 8, which is, did the deceased change or dispose of their pension in the 2 years before they died? Now, what do they mean by the phrase change or dispose of their pension? At this stage, I would suggest that you look at the explanatory leaflets 206, IHT 206, which are the explanatory notes. Examples of the sort of changes that HMRC have in mind are where the deceased has allocated some of his pension to someone else. But please note you can ignore any pensions paid to a surviving spouse or civil partner, which will in practice cover many situations. Other examples of how people can change the benefits you'll see listed in the booklet which I mentioned, but they include making additional contributions, transferring the deceased benefits from one pension scheme to another, failing to take up his pension on reaching pension age, failing to request in ill health retirements where he meets the requirements for that form of retirement, opting for income drawdown, opting for phased retirements. all those items. So now we go on to page 3. We are now in the third section of the questionnaire, dealing with the deceased's assets at the date of death. So just a quick reference to the note at the very top of this page. Make the fullest inquiries so that you can show that the figures on this form are correct. If you cannot find a value for an item, you may include your best estimates. However, please be realistic. HMRC, Her Majesty's Revenue and Customs, can and do carry out spot checks. And if they find that an estimate is out of line, there can be fines and penalties. This section is divided also into several parts about assets and debts payable out of it. So we'll crack on. Question 9.1. This asks about gifts made in the 7 years before the person died and is referred to earlier in question 2. The form now asks for details of any such gifts. Remember, as I said before, that any gifts made during this period eat into the nil rate band of £325,000. So, for instance, if the deceased made a gift of £100,000 during that period of 7 years, then the nil rate band will now be £225,000. Question 9.2. The deceased's share of assets passing automatically to the surviving joint owner. If the deceased owned the property with their spouse as joint tenants, actually it can be anyone, but I'll say spouse for the purpose of this webinar, then the legal title passes automatically to the surviving spouse. However, the deceased share still has to be accounted for inheritance tax purposes. The value of the deceased share would be half the value of the house. If there is a mortgage, then that is dealt with later in question 10.1. Just a quick note, valuation of property can be difficult. HMRC notes strongly recommend a professional valuer, but of course such a person will charge for their services. Personally, I think you can look online and get a realistic valuation. But as I said, please be realistic. HMRC will know the values of property in your area, and if you put in an artificially low figure to get within the £325,000 tax-free band, this will show. Also, another word of caution, this question only applies to property owned as joint tenants. The other way of owning property in joint names, tenants in common, is dealt with later on in question 11.9. Question 9.3, assets held in trust for the benefit of the deceased during their lifetime. Again, we're in the realm of trusts, and again, I would say that if there are such assets, you are best taking advice. These talks are too generalized to be useful in that context. You should be able to establish whether there is such a trust by looking through the deceased's papers. Question 9.4, nominated assets, i.e., has the deceased made provision for an asset to go to a particular person? However, the definition of these is pretty limited, as the only assets that can be nominated in this way are, to quote directly from the explanatory booklets, deposits of up to £5,000 in friendly societies and industrial or provident societies, or before the 1st of March 1981, national savings certificates and accounts. Question 9.5, assets outside the United Kingdom. If you have any such assets, you will need to exercise great care, and I would suggest that in this case you will need professional help. That brings us to the end of this section. Right at the bottom of the page, you have to tot up the amounts in boxes 9.1 to 9.5 and put the total in box A. Page 4. The second part of this particular section is about debts, which are payable out of assets for which a grant or representation is not required. So the first question is, what is the deceased's share of the mortgage? You'll remember that there was a question earlier, question 9.2, about the deceased's share of the value of the house. You have to take off his share of the mortgage, and that value goes on here. You should have a statement from the lenders which would give you the amount to put in here. So just to be clear, If it's owed as joint tenants, you take the value of the property, halve it, and you put that amount in the earlier question, 9.2. You take the value of the mortgage, which you get from the statement, you halve that, and that's the amount you put in here, 10.1. Question 10.2. Did the deceased owe any debts out of assets that are jointly owned? If so, then this amount goes in here. Question 10.3. Debts payable out of trust assets. This question ties in with question 9.3 before, and as before, I would say that if there are trusts involved, you need a specialist. Question 10.4. Debts owed to persons outside the United Kingdom. This ties in with the earlier question 9.4, and again, I would suggest that if this question is relevant, you need a specialist. You then add up the amounts from amounts in boxes 10.1 to 10.4 and put that in box B. You then deduct box B from box A, and that is the amount which goes in box C. Then the next part of this particular section is questions 11.1 to 11.11, which deals with assets for which a grant of representation is required. So question 11.1. Cash in any bank or building society account or national savings accounts. You will see that there is just one box here, so you add up the various accounts and put the result in here. Question 11.2, household items and personal goods. Note that you cannot put simply nothing or nil in here. HMRC, Her Majesty's Revenue and Customs, won't accept it. You can put in an estimate, though as I said before, you should be realistic. I often put in a figure of around £5,000 here, which is usually more than enough to cover all such items. Question 11.3. Stocks and shares quoted on the stock exchange. You can use a stockbroker to get the prices here, or you could look online. 11.4. Stocks and shares not quoted on the stock exchange. A bit more care is required, but you should write to the company secretary, who will provide you with the value of that investment. Question 11.5. Insurance policies, including bonuses and mortgage protection policies. You should be able to get this information from the companies involved. Question 11.6. Money owed to the person who's died. The only way to find out about this is to look through their papers and records. Question 11.7. Partnership and business interests. Getting a valuation of these items is a skilled exercise for which you will need an accountant. Question 11.8. The value of the property, whether freehold or leasehold, if owned in their sole name or as a tenant in common. We're talking about their interest in a property owned as tenant in common, because in law, that part belongs to them, not to joint names. So remember the distinction between joint and tenants in common. If the deceased interest was as a joint tenant, that goes in earlier in box 9.2. If he owned it as a tenant in common, then the value goes in here, box 11.8. Page 5. Question 11.9. Any other property owned by the deceased in their sole name or as a tenant in common, that's any other property, such as property which is let out. If the deceased did own other properties, then the likelihood must be that the estate is nudging that tax-free band of £325,000. So if this applies, you might want to check whether this is the right form. Similarly, question 11.10, the value of other lands. Included in this is items such as farms, business property, and timber and woodlands. Again, if the deceased did own property like this, it is hard for me to believe that their estate doesn't exceed the tax-free band, so this may be the wrong form. And finally, in this section, question 11.11. This essentially is a mopping up question, things like refunds, income tax repayments, etc. So in here you would put arrears of wages and refunds from electricity or gas suppliers. At the end of this section, you add up the amounts of the assets and put the value in box D. As you will remember, these questions 11.1 to 11.11 deal with assets for which a grant of probate is required. Questions 12.1 to 12.3 are about the debts payable out of those assets. Question 12.1 is the funeral expenses. Not just the funeral itself, but the headstone, if any, the flowers and refreshments, but not apparently travelling costs. Question 12.2 is the deceased share of the mortgage, where he owned a property as a tenant in common. So you need to add up these amounts and put the figure in box E. Now you will see that there are three further boxes, F, G, and H. This way it gets a little bit funny. So box F, this is the difference between box D, which you'll recall is the assets for which a grant is required, and box E, which is the debts payable out of those assets. That figure goes in there. Box G, you add box C, which is the net value of assets for which a grant is not required, to box F, which we just dealt with. Box H, you add box A, which is the gross value of assets for which a grant is not required, to box D, which is the gross value of assets for which a grant is required. You'll be delighted to know we're nearly at the end of this form. Question 13. You should put in this box any information which you believe should be taken into account. You should put anything here which you think might help to clarify matters. It is hard to tell you what to put in here, if anything. If it is a straightforward estate, you may not need to say anything at all. An example of what could go in here would be to explain what properties the deceased owned as a tenant in common and in what proportions. So we've gone to page 7, which is the exemptions. If the value in box H, further up, is less than £325,000, which it needs to be for the purposes of this webinar, then you can just write nil in box J and copy the value in box G to box K. If the amount comes to more than £325,000, but you're claiming the nil rate band from the deceased estate under the various exemptions you can claim, then you need to put this amount, you need to save this here and put the amount down in box J. You need to do some research on this point. This webinar is really designed for people who simply come within the £325,000 figure. If the amount comes to more than £325,000, but you claim exemptions to make IHT not payable, then those details need to be put in here. There is a list of examples of what may be relevant to put here in the IHT booklet on page 24 of that booklet. So it may be worth your while looking here if you're not sure what to do. And page 8, at last, we come to the declaration, which you need to read carefully and sign. You'll note that if there's more than one executor, each of them needs to sign this form.